Hey everybody, welcome back to Whiteboard Finance. My name is Marco and I'm here to help you master your money and build your wealth. Thanks for Policygenius for sponsoring this video, but more on that later. So, are you looking for an investment portfolio designed to weather any storm? This is so stupid. I'm about to destroy my whole set. My bad. I don't even think it's good luck to open up an umbrella indoors anyway, so I probably just jinxed this whole video. But seriously though, if you think that there's an impending market crash or cycles that are coming up, I have just the portfolio for you. It is Ray Dalio's all-weather portfolio. So in this video, we're gonna be analyzing and recreating Ray Dalio's all-weather portfolio designed to build and preserve wealth through diversification. We'll take a deep dive into what holdings make up the all-weather portfolio, and we'll analyze this portfolio's historical returns and drawdowns. And finally, I've actually recreated this portfolio in M1 Finance to make it really easy for you to integrate it into your own portfolio if you would like. Stay tuned. Okay, so what is the all-weather portfolio? The all-weather portfolio is modeled after the all-weather fund from the famous hedge fund Bridgewater Associates. The portfolio idea was created by the legendary Ray Dalio, who is the founder of Bridgewater. Dalio is a self-made billionaire who is highly respected and rightfully so. I personally own his best-selling books, Principles, which I recommend reading. And I also enjoyed watching his video on how the economic machine works, which is on YouTube as well. So Dalio is a macro thinker who is famous for analyzing and adapting to economic cycles. So this is why the all-weather portfolio exists, to survive all economic environments using different types of assets that perform differently during those different seasons of weather, right? AKA economic cycles. So the all-weather portfolio is designed to maximize diversification using a variety of uncorrelated asset classes. This provides diversification, and for example, when stocks go up, typically bonds tend to go down, and when stocks go down, bonds go up. So this eliminates any guesswork on the investor's part, aka you. Okay, so what actually makes up the all-weather portfolio? Now here's the question you've all been waiting for. So you can see here, or maybe not see here so clearly depending on how big the screen is that you're viewing this on. Some people watch these on cell phones, some people watch it on big screen TVs, but I will have a second part to this video later on where you're gonna see this all blown up anyway. So you just kind of have to hear me out here. So it's actually 30% stocks, US stocks, 40% long-term bonds or treasuries, 15% short-term bonds or treasuries, 7.5% commodities, diversified, and 7.5% gold. The reason for this is because all of these assets deal with different cycles or seasons of weather. Again, that's why it's called the all-weather portfolio. Dalio proposes that the following four things affect asset value. You have inflation, deflation, rising economic growth, and declining economic growth. Based on these four things, Dalio expects we can see four seasons of the economy. So you have higher than expected inflation, aka right now, lower than expected inflation, higher than expected economic growth, and lower than expected economic growth. So now in the second half of this video, we're going to dive into the performance of this portfolio, but before that, let's have a quick word from Policygenius. If someone relies on your financial support, whether it's a child, aging parent, or even a business partner, you need life insurance. There is a feeling of comfort and, in my opinion, reduced stress in your life knowing that your loved ones are covered in the event of something happening to you. Policygenius makes it easy to compare quotes from over a dozen top insurers all in one place. You can save 50% or more on life insurance by comparing quotes with Policygenius, and you could save $1,300 or more per year on life insurance by using Policygenius to compare policies. Getting started is easy. First, head to policygenius.com/whiteboardfinance. In minutes, you can work out how much life insurance coverage you need and compare personalized quotes to find your best price. When you're ready to apply, the Policygenius team will handle the paperwork and scheduling for free. Policygenius never sells your information to other companies, and they don't add on extra fees. The licensed experts at Policygenius work for you, not the insurance companies, so you can trust them to help you navigate every step of the way. Head to policygenius.com/whiteboardfinance to get started right now. Okay, everybody, welcome back to the second part of the video. We're going to take a deep dive into the performance of the all-weather portfolio using some ETFs based on this one website. Just very quickly, some of you probably noticed that I have rips in this jacket. This is a really nice waterproof Helly Hansen jacket. I actually crashed on my bike. It was pouring out. I was going about 20 miles an hour. I tried jumping this curb. So if this is the street and then this is the driveway, the curb, I raised my front tire over the lip of the driveway, but my back tire completely caught and basically swiped the bike from underneath me, and I crashed going about 20 miles an hour, and this is the only damage except for my palms and my arms and stuff. I actually had a consulting call that I do, and I ended up taking the consulting call in this woman's salon, literally bleeding from the palms and elbow and everything. It was bad, but I digress. So anyway, probably lost about 90% of the viewers there, but it was an interesting story. So this is lazyportfolioetf.com. It actually highlights some of the things that we're going to talk about the Ray Dalio all-weather portfolio. As we mentioned before in the video, it's exposed for 30% of the stock market, 15% commodities, and you can see here that it's considered a medium risk portfolio using 5 ETFs. So over the last 10 years, this portfolio had a 7.72% compound annual return with a almost 6% standard deviation, meaning it's ups and downs, which we'll talk about here in a second. So in 2020 overall, the portfolio basically averaged out to be 1.4% in dividend yields, which is definitely higher than your high yield savings account online, but definitely not keeping up with inflation in my opinion. So this is the chart that I wanted to show you that was a little bit harder to read on the whiteboard. You can see the breakdown very quickly and the symbols that this person used to create this portfolio. And just very quickly on M1 Finance, I actually created this pie right here, the all-weather portfolio, so you can easily, if you use M1 Finance, you can just easily use these ETFs right here. So before we get into that, let's check out what this person used. We have 30% equities and U.S. large cap, which is VTI. This is basically Vanguard's total stock market ETF. You then have 40% bonds, long-term, which is TLT, fixed income. Then you have 15% bonds, which is U.S. intermediate term, IEI, ticker symbol. Then you have 7.5% commodities and gold. This person is using GLD, which I did as well. And then you have 7.5% commodities, which are diversified using ticker symbol GSG. So if we take a look at this portfolio with those ETFs, this is exactly what those ETFs are. So if you want to take a screenshot or pause the video, you can recreate it using this, or you can recreate it using this right here, which is what I used. I personally like Vanguard. I've been using them since I was about 19 years old. Okay, so basically, if you want to look at this portfolio, how it's done, you can see the time frames here: 1 month, 3 month, 6 month, 1 year, 3 year, 5 year, 10 year, and you can see here in the 10 year, this is what each one of these components has done over time. So if I zoom out so you can see this, you can see that VTI was about 14.7% over the past 10 years. Remember, guys, we're in an unprecedented 12, 13-year bull market ever since the 2008 crash. The Fed has been printing money like crazy. Not so hard to achieve these kinds of returns. So anyway, take this with a grain of salt is what I'm trying to say. So past 10 years, total stock market was 14.7%, 20-year treasury bond 7%, which is really high for bonds in my opinion. 3 to 7 year treasury bond 2.4. The gold spider, gold hasn't done anything in 10 years. It's just basically preserved wealth. It's up 1.27%. And then commodities have been getting crushed, but they're actually on a comeback now in the more shorter term, as you can see right here. Now, if you take a look at this portfolio, you can see that its max drawdown was basically over the course of, if you go max right here, which is July 1st, 2002, it had its biggest drawdown of 12.19%, and that was basically from July 2008 to February 2009. That's when 2008 happened, right? So anyway, if you're a young buck or a young investor, you probably don't remember this. You only remember the joyous 12, 13 years that we've had now with an unprecedented bull run, but don't get off the roller coaster if it's still going up, right? So my point is that you can see the returns here annualized max. This portfolio is up 8% overall. If you look at its max drawdown, meaning the worst point in history that this portfolio, based on these ETFs that this author created, is down 12.9%. So to put that in other words, if you have $100,000 in this exact portfolio with these exact weights, your max drawdown would be $12,190, if that makes sense. So same thing with M1 Finance. The reason I like M1 Finance is because you can weight all of these funds into a pie, and you can literally dollar cost average straight into this thing forever. So if you're not familiar with M1 Finance, I highly suggest you check out my free training below. There's no strings attached. It's literally 100% free, and you can divide all of your investments with percentages, just like this person has done here. So if you compare this to some other medium risk portfolios, you can see here, some of you may be familiar with these, some of you maybe not. You have Scott Burns, who has his couch potato portfolio. Over the last 10 years, he's averaged 9.18%. On an annualized basis, which is 50% stocks, 50% bonds. If you go with your typical risk parity portfolio, which is basically what this all-weather fund is modeled after, it's an 8% 10-year annualized return, 40% stocks, 60% bonds. And you can see here just below that by 28 basis points less than 8%, you have 7.72%, which is the all-weather portfolio, which is what we're talking about today. 30% stocks, 55% bonds, 15% commodities. So if we continue on, you can see your capital growth. I'm going to maximize this. That way you can see everything pretty easily. So if you invested $1,000 into this portfolio from July 2002, okay, which is basically 19 years ago, your $1,000 would now be worth $4,337.07, which is basically a 331.7% return. Which is 8% annualized. Okay, this is pretty good for being such a conservative portfolio and so diversified as it is. Now, the thing that you really need to focus on with this portfolio, a lot of the young people watching this video that are used to 8 bajillion% returns in meme stocks and crypto and all this other garbage that's being spewed online, other than Bitcoin, buy Bitcoin. You can see that the maximum drawdown here in February of 2009, which we talked about earlier, was 12.19%. Other individual stocks got crushed 30, 40, 50, 60%. This entire portfolio overall has only seen a max drawdown of 12.19. Make sense? So if we go down to worst drawdown since June 2002, we talked about this earlier. You can see here July 2008 was the worst. That was the start. The bottom was February 9th. It lasted 8 months. So if you can withstand these, 8 to 12 month droughts, or actually let's call it 4 to 12 month droughts, basically, you should be fine with a portfolio like this. If you look at its rolling returns, annualized rolling average, you can see that it's not very volatile, okay? The worst volatility you had here was a year ago because of what happened with the cerveza sickness, but right down the middle, it's always been consistently just about 7%, 7.5% annualized return, if you will. So there's seasonality. This doesn't really matter if you're a long-term investor. And there's obviously things that we can talk about here, which just basically overcomplicate everything. But for me personally, at 33 years old, this portfolio is still somewhat too conservative. It has 55% bonds, okay? What the hell do you need that for if you're under the age of 70? Okay? Bonds are dead, dude. I think the next big bubble is in corporate bonds, to be quite honest, and then municipal after that. But if they keep with the helicopter money, then it doesn't really matter. But at the end of the day, it's way too much bonds. If you look at my M1 Finance portfolio here, it has $103,000 in it, and I promise you, it has 0% bonds. Okay. That is not the move, in my opinion, unless you're significantly older. And that 60-40 risk parity portfolio is pretty much dead, in my opinion, just because inflation is much higher than what bonds are yielding right now. Okay, so it's kind of pointless to have those in there. This is not financial advice. It's just what I would do if you were in, 18 years old to about 55, really, 59 and a half, maybe right before you're going to retire and tap into some of those Roth IRA funds. So I hope all of you watch this video in its entirety. Check out all the links down below if you want to sign up for M1 Finance. There's absolutely no fees. I love it. I use it. I have $125,000 of my own money in there. Check it out down below. Or if you want the free training, check it out down below as well. Thank you so much and have a prosperous day.